At the GAIM conference for hedge fund managers in Florida, people are pretty upbeat about what we're going to see this year. Simon Lack might have a slightly different approach. He is the author of The Hedge Fund Mirage. Good to see you once again, Simon.
Good to be here.
All right, so are you going to tell us that basically some of what we're hearing might not be exactly what we think?
In my book, the first sentence is, if all of the money ever invested in hedge funds had been in treasury bills instead, the investors would have been better off. That's basically what's happened. The average dollar didn't earn a good return. And the book has been out a year. I finished writing it in 2011, and since then, hedge funds have basically, confirmed what I said. And 2011 was a pretty miserable year. 2012, hedge funds were up about 5%. Obviously,
but not as much as the market, right?
Missed by a lot, by about 11% against a 16% S&P. So the hedge fund industry is overcapitalized. There are great hedge funds, there are happy clients, but in aggregate, it's been a bad experience for investors.
Do you think we'll see more funds winding down this year or starting up?
That's a great question. I think you'll see both because, one of the very reliable features of hedge funds is that the early years are good. So, new hedge funds often generate really attractive returns, but then they become successful and big and the returns go down. So I think you can see both of that. Clearly, assets continue to flow into the industry at the margin.
Well, let me ask you a little bit about what we're seeing in the market right now, because I'm thinking of the first line of your book, and investing in treasury bills now is not always the best place to be. What are you advising in terms of how you make a decent return these days? Should we be purely equity focused given what's happening in fixed income? And do you think we're actually in a bond bubble that will burst?
Well, here's the deal, right? You could take $100 in 10-year treasuries. They yield 1.8%. You sell the 10-year treasuries. You only need to put $22 in the S&P, yielding 2%. And your 10-year return on the $22 will be the same as the $100 in 10-year treasuries. So in other words, you can have $22 in stocks, $78 in cash, and you'll have your own synthetic bond. Interest rates are below inflation. The government's policy is to transfer real wealth from savers to borrowers as a way of paying down all of the mortgage debt and other debt that we have. And in my opinion, investors should say, if the government likes bonds that much, let them own the lot. And so I think investors should have no fixed income. They should use equities and they should use cash in a barbell strategy based on their risk appetite to generate returns. I think bonds are overpriced and you should exit bonds.
When you say no fixed income, you mean corporate bonds, high yield debt?
I think there's a case for high yield, although high yield bonds generally give you equity type risk and equity type returns. So it's sort of a closet way of having equity risk. I think master limited partnerships are a terrific yield generating strategy, and I think MLPs give you the same sort of volatility as high yield bonds with better returns. I think dividend yielding stocks are a great investment. I think dividend yielding stocks with an equity market hedge are a great investment, and I think broad equities looking for growth strategies are good.
And when you look in the equity space, are you looking globally?
No, we focus in the US. I figure, America's a big enough place. If we can't find something good to do in America, we're just not looking hard enough,
But are valuations getting a little bit stretched? I hear different commentary on that, if you will, depending on who I'm talking to. We're not that far away from all-time highs in the stock market.
It depends. When you look at individual companies from bottom up, they look really, look at Berkshire Hathaway. Berkshire Hathaway trades, a little bit more than 20% above book value. Warren Buffett has said he'll buy back stock potentially at 20% over book value. They've owned Burlington Northern, which is now shipping increasing amounts of oil from North Dakota down into the south to the refineries. They're in housing, they're in insurance where margins are improving. I think Berkshire Hathaway is a good investment. I think that McDonald's is a good investment, Coca-Cola. So when you look at individual companies, you can really find some attractive opportunities. When you look at the market as a whole, it's always possible to be nervous and, Washington could mess things up. No doubt, there's always some risk out there. But if you do bottom-up analysis, you get much more comfortable with what you own and why you own it.
Anything look incredibly rich? I'm thinking of some of the tech names that lost some steam at the end of last year. Apple.
Yeah, we don't, I've never owned Apple. Fortunately, most of my clients have owned Apple at various times. They don't need me to own it as well. We don't really invest in tech stocks. What's really expensive? I think REITs kind of look expensive. We own one company, Corrections Corp, which is in the process of converting to a REIT, and it's had a great run, and we've made some good money on that, and we're happy to see that conversion take place because we think that they'll be converting into a sector that is fairly richly priced. No, we really focus on where we think good places to invest.
Well, when you have this bottoms-up strategy, what are corporations going to do with all this money, do you think, this year? Do you see dividends increasing? Do you see pickup in M&A? Do you see...
I think that broadly speaking, a lot of it depends on government policy and eliminating uncertainty. So right now, you've got the risk of sequestration. We've pushed back the debt ceiling issue for 3 months. There may be tax reform this year. A lot of corporations in the US have money outside the US, and many of them are waiting to repatriate based on if there's a change in corporate tax policy. So I think that eliminating uncertainty about fiscal policy and tax policy will go a great way towards helping companies decide that, yeah, we should take that risk. Honestly, if the government just gets out of the way, I think there's a lot of great opportunities for companies to take advantage of.
Simon Lack, SL Advisors. Good to see you once again.
Good to be on. Thanks very much.
I'm Rhonda Schaffler. This is Reuters.